Rajat Rajkadia, Director Research with Motilal Oswal Securities, joins us live from his Mumbai office. Rajat, morning. Thank you for joining us. Rajat, after the recent rally, which way are you leaning? Are you leaning towards momentum and liquidity, or are you of the view that the run-up has been too swift and too speedy? It's time to exercise some caution now.
Good morning. Well, I think there are two ways to look at the market. First, whenever we see some period of liquidity, we see this 6,000, 6,100 levels getting touched into the market. This is almost the fourth time in the last 4 years where we would have seen this range getting tested. Secondly, we normally look at euphoria more from the P, looking at the P of the market and not at the absolute level, because every time you touch 6,100, the underlying multiple keeps on getting lower as you are adding the earnings. So there are two sides of the market, one fraction of the market which is making newer highs with every passing month, and the second section where stocks have been trading within a range and right now they are at the top end of this range. But for us, the view is that for the markets to move up further from here, you would need the growth to return back, because that PE band multiple has again taken us back more closer to 15 times, and unless we see the growth returning back, that multiple expansion is quite unlikely right now.
So Rajat, what is your sense? I mean, have we seen any retail participation come back into the markets, or what we've seen in the last 3 weeks has been purely an FII-led move?
Well, there are two sides of the retail. One side of the retail which participates through the domestic mutual funds and insurance, and the other part of the retail which participates directly into the market. I think the other part of the retail has become completely non-existent. Whatever they trade, they largely trade into the FNO now. They trading into the cash segment is very, very minimal. So that's probably more of a structural change that we have seen into the markets. Coming to the first part of the retail who trades through the institutions, where we start seeing mutual funds and insurance start getting inflows, that process has still not happened. That process will still take some time. But what we are hearing from people over the last 1 month is that the redemptions or the outflows have eased compared to the trends that we were seeing in Jan, Feb, March quarter. I think two things are important. Some of the alternate asset classes will have to start showing less attractiveness for that retail to come into the markets, and through that I mean gold, real estate or fixed income. Gold, we have seen some crack. Fixed income, I think we will see deposit rates now coming down over the next 3 to 6 months. That's a consensus view. And the last is real estate. Once you start seeing people making less money there, I think equities as an asset class will start standing out.
Rajat, whereas we always tend to focus on global liquidity and what foreigners are doing, let's talk about the domestic liquidity picture. And it's rather a big irritant to see that on a daily basis, domestic institutional investors are sellers. And in last 4-5 days, the selling activity from the domestic side has only intensified.
Well, yeah, that's true, because there are three reasons to that. First, if you look at the redemptions that we have been seeing into the insurance in particular, that number has still not completely eased off, because that process is still on. Although we know that the redemption pressure has eased down, but still there are outflows. That is one. Second, I think we always see that whenever markets reach at the higher end of this band, at least some domestic institutions look to raise cash, because the basic conviction level in this rally has been very low. Typically, you see a 10% kind of an index moves more frequently now, once every quarter. So unless you see a trend breakout, people are still viewing this as a trading rally. That's the second. And third, I think the liquidity in the system has still remained quite tight, because if you look at the RBIs, they themselves are infusing almost 1 lakh crore on a daily basis into the reverse repo. So I don't think that the liquidity in the system per se has improved. So all these three factors are ensuring that as people get good prices, the first reaction is still to sell out and wait to buy lower, because of which you are still seeing daily selling by the domestic institutions.
So where is there money to be made, Rajat? Is it in the spaces which have already run up or rather driven this leg of rally, the financials and the rate-sensitive lot? Or do you think it is going to be newer spaces like a cap goods which is going to emerge in the next 2-3 weeks?
Well, I think the money will be made where the outlook on the growth rate improves, and at least the first big trend that we have seen right now is that the bond markets have given a signal that the transmission of monetary easing should happen into the system. The bond markets have reacted. Now it's the turn of the corporate bond markets and the bank lending stroke deposit rates. Once you start seeing that happening, then at least some leg of the growth will start returning, which means that whether be it stocks like financials, autos, capital goods, we are still right now unsure because I think it's going to take some time before you see the investment climate. That doesn't seem to be changing in the next 6 months. But as I mentioned earlier, that this market is divided into two parts. One which makes new high every time you see the Nifty crossing 6,000. And the second which trades in a band, which is the financials, autos, capital goods. Whether you look at stock like an SBI or a stock like a Tata Motors or an L&T, the three representations from the three different sectors, they still trade in a range and they are at the top end of their range right now. For them to break out of this range, you need to turn positive on their growth rates for FY14. There are very few signals for one to turn positive, and that is why you are still seeing net selling by the domestic guys.
And I could also add IT in that list because IT sector per se, with the exception of HCL Tech, none of the key IT companies have seen a big P expansion. So Rajat, to your mind, at the current juncture, where is there scope or room for a P expansion?
Well, there are many spaces where valuation rating expansions exist. For example, if you stocks like M&M or stocks like Tata Motors, right? While M&M is now closer to the $1,000, I think the kind of growth that can return to them, it will return back multiples also, which will be better than what they are seeing right now. Second, I think is telecom, where the earnings upgrade cycle seems to have started a little bit in favor of Idea, still not yet for Bharti. But this is after a multiple years of downgrade of cycle that we have seen for these sectors. So there is a good valuation re-rating scope that exists for these two companies. Third is the entire energy pack. I think we have seen stocks like ONGC, which have been going through a huge period of reforms, but the stock is very range bound between 300 to 350. I think there's a lot of scope of valuation re-rating that happens. And lastly, some of the financials, beaten down financials, as and when we see the asset quality issues plateauing out and things looking little better, which could still be 1 quarter away, there's a lot of scope for re-rating to happen there.
Rajat, Nestle currently is at 5,000. Do you think in next 3 years Nestle could easily be at 8 to 9,000? It's an expensive stock, but it's a very strong franchise.
Well, I think the stock definitely has room to reach those price targets. I don't know whether it will be in 3 years or little longer. But one of the very important characters of all these MNC-owned Indian companies are that most of them have some non-fundamental premium getting built in after what we saw in GSK Consumer or Hindustan Unilever. The two important things: first, the ownership pattern of these stocks is very, very concentrated. And second, whether these stocks deserve to trade at 25p or 35p or a 45p, I think over the last 3-4 years, they have defied all those logics. And that's why even Nestle, which has seen a very muted earnings growth over the last couple of years, single digit kind of an earnings growth, the PE multiples have not shrunk below 30-35 times. So there is always some non-fundamental premium which is built into these companies, and GSK Consumer and Hindustan Lever has further fueled that premium into many of these MNC owned Indian stocks.
Rajat, here's some interesting data for you. From 12th of April, Nifty is up 11%, The Bank Nifty is up 15% and the FMCG index is also 15%. All of us thought that the large part of this rally is largely because of macro factors and because of crack in commodity prices. But guess what? The FMCG index and the bank index, they are moving neck to neck.
Yeah, that's a good data. But I think if we just do a little bit of adjustment, that because of the Hindustan Unilever open offer, that big bump up into the stock of over 20% plus would have contributed a good chunk to the FMCG index rise. That is one. Secondly, as I mentioned that while financials have led this rally, you have seen even the top run financials like an HDFC Limited or an HDFC Bank also participating in this rally. Which is why this rally that we have seen is not just a rally about the beaten down stocks, but it's also the rally where the names like HDFC Group, Sun Pharma, ITC, Hindustan Unilever, all of these stocks have also done quite well. And this is a function of the big flows that you are seeing from the FIIs and some pickup that you are seeing from the domestic, because of which the beaten down names are also doing well.
Rajat, final question. I know you are headed for your morning call. So what do you think will be the big theme of your morning call today? What are you telling your clients in your early morning communication?
I think there are two things. First, we think that the currency weakness that we are seeing, despite all this positiveness in the markets, is something which is a lot more structural, and because of which, as currency remains for a longer period at 55, a lot of these dollar-denominated business models will keep on doing well. That is one. And second, the bond market rally has played out quite well. The government bond market. Now it's the turn where the beneficiaries onto the corporate bond market should do well, and some of the wholesale financiers like an LIC Housing Finance or an IDFC, and even within the PSU pack, stocks like Canara or OBC, which has higher proportion of these high cost deposits, should do well from here.